This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
Another week, Ben, another great guest. This week we had William Bengen. Bill Bengen, as we've always called him on the podcast, who is the financial advisor who first articulated the 4% withdrawal rate, otherwise known as the 4% rule.
The people we talk to is just crazy because it's like, I entered the finance industry 8.5 years ago, and people like Bill are like famous. And then to sit down with them and chat is it's pretty cool.
Yeah, I had heard him on another podcast, and I just linked up with him on LinkedIn and asked if he'd be willing to join us, and he responded right away. And here we are talking to Bill Bengen. What a phenomenally nice human. What a great guy. We had a great chat with him. And Bill's got an amazing story too. Like, he has a background in aeronautics and astronautics from MIT. He's also co-authored the book Topics in Advanced Rocketry, which he wrote in 1973. So he is a rocket scientist.
He is a rocket scientist. Yes, he had a career in financial planning, but he is a rocket scientist.
And so he tells a story in the interview of how he ended up becoming the discoverer of this 4% rule and financial planning practice. So we won't, spill the beans on his career story, but it is a great story.
He's had a ton of other research, like he's famous for the paper, the 1994 paper, Determining Withdrawal Rates Using Historical Data. But he's published lots of other research, a lot of it along similar lines, like that idea of using historical data in the US to determine safe withdrawal rates. That's been, at least most of the research that I was able to find that he's done has focused on that. So that's kind of his bread and butter. And even as recently as December 2020, he's had new stuff out that, as we talk about in the interview, pushes that idea of, again, using US historical data to find safe withdrawal rates, pushes it to a whole other level, just in the way that you can slice up the data to look at different inflation and price earnings regimes and how that can impact safe withdrawal rates. So he was cited not long ago saying that while everyone's saying that the safe withdrawal rate is 2% or something like that, he actually thinks it could be 5.5%. Mm-hmm. And I read that and thought, that's ridiculous. How could that possibly be sensible? But it's from that. It's from slicing up historical data into periods where prices were high, but inflation was low. And when you look at that subset of historical periods in the U.S. data, higher withdrawal rates rather than lower have actually been possible, which is just fascinating. And I mean, the 4% rule finding, that was dictated by a period that had a combination of low returns and high inflation. Anyway, there's lots of traps in there where we don't really know what future inflation is going to be, obviously. But just being able to, when I saw how analytically rigorous his comment about 5.5% being a sensible withdrawal rate in the current environment was, I was impressed.
And he only started in this field once he turned 40 years old, which is kind of interesting, after getting out of the family business and then being a numbers guy from his education. That's what drove him to this. But he had a financial planning practice up until 7 years ago when he sold it, but the research continues. But it was so cool to me because we've talked about his research for years in client meetings. So I just found it really fun just to get to ask the guy the questions that kind of come up in client meetings. It was a really, really cool experience.
Yep, absolutely.
Anything else to add?
No, I think that's good. We did cover a lot in the conversation with Bill, so I think we're good to go ahead and play the interview.
Bill Bengen, it's with great pleasure that we welcome you to the Rational Reminder podcast.
Thanks. Appreciate the invitation. Great to be here.
Yeah, we're so happy to have you. So in 1994, your analysis in determining withdrawal rates using historical data, I think it's safe to say, changed the way people think about retirement planning. And your finding is often quoted as the 4% rule. Can you describe what your 1994 research finding was?
Yeah, your question made me go back and take a look at my original paper. And when I reread it, I did so with quite a few smiles because 27 years ago, knowledge has advanced a lot since then. But my basic findings were still reasonably, acceptable in today's world. That if you were withdrawing during retirement from a tax-deferred account and you expect to live for 30 years and you wanted your money to live for 30 years, a 4% withdrawal rate the first year and then increasing for inflation each year after that has always worked historically. And that was just using two asset classes. That was using large cap stocks and intermediate term treasuries. And the asset allocation that came out of that was about a 50-50. Turned out to be optimal for that.
So you found that with a 50-50 allocation, a 4% withdrawal rate was sustainable. Why do you think that finding? I mean, you published this in a research capacity, but you've also practiced as a financial planner. Why do you think your finding was so impactful to the financial planning industry?
Well, I think once it was a very simple, straightforward, and it had been researched, I could back it up. I remember back then, there were a lot of ideas thrown around what was an appropriate withdrawal rate during retirement. Some people said, oh my goodness, you're in retirement now, you got to sell all your stocks, invest only in bonds, take out 2% and you'll be fine. Others said, oh my goodness, no, you have to, a balanced portfolio return 7.5% a year, 8%, you should be able to take out 6 or 7%, no problem. And so they're all over the map. For the first time, I brought, something that I had studied and researched and could justify, and not everybody liked it. I'll be honest with you, I got a lot of hate mail from people on those findings, believe it or not.
Can you talk more about that hate mail? That's something that I've not heard.
Yeah, there are a lot of people, in the business who advise their clients a certain way, who use different numbers, and who had convinced their clients. And then here's this upstart financial planner, been in business maybe 4 or 5 years, and says, no, 4% is it, guys. Sorry, 6% is way too much. 2% is too conservative. So I guess it created problems for them. With their clients and with their, new ideas are always resisted, no matter what they are, no matter how justifiable they are. So I did get some pretty nasty mail, but that quieted down after a while. Unfortunately, subsequent studies verified my findings, and over time, it became accepted. Thank goodness. I hate living in fear,
It's kind of ironic if your 4% rule is lower than what a lot of people are using. That would have meant they needed more assets, right? Which is obviously in the advisor's best interest. So it's funny that may have triggered hate mail.
Yeah. I was pretty astonished by the reaction. I never expected that kind of response. I wish I'd saved some of those things. I just threw a lot of them out because I said, no, I don't want to deal with this.
Do you think that this reaction came from a lot of people that may have used, just rough rules of thumb as opposed to the more research-based opinion that you came to?
Well, yeah, I think that's all there was at that time, pretty much. I imagine that in some sophisticated endowments and pension plans, they probably had done somewhat similar research over the years, but I couldn't find any trace of it when, I first looked for it back in the early 90s. So people were just going on gut feeling, and gut feeling can sometimes betray you.
Interesting. So after your 94 paper, you updated the 4% rule to a 4.5% rule. Can you talk about what went into that update?
Yes. I threw in another asset class, small cap stocks, U.S. small cap stocks. I chose them as kind of a proxy for a lot of other asset classes. One, because they had a higher rate of return than large cap stocks by about 2%. So they're adding return.
Yep.
And they didn't have a perfect correlation with large cap stocks. So they added some diversification value. And that worked out pretty well. It raised, I think my early work indicated around 4.1, 4.2, and this brought it up to almost 4.5. So it was a pretty substantial increase in prospective withdrawal rates with that change.
You did another research update more recently, very recently in December 2020, and this I found to be fascinating. So you wrote that despite prices being high, as measured by the Shiller CAPE, which has Michael Kitces found prior to this, tends to predict lower withdrawal rates when prices are high. So they're high now, but we also have low inflation expectations. And you've found in your most recent research that under those conditions, the withdrawal rate could actually be higher than 4.5%, which is contrary to what a lot of people, including me, have been saying because of how high prices are. Can you talk a little bit about that research?
Yeah, I know a lot of my colleagues who I respect have been saying, maybe it should be 3.8, maybe it should be 2.8, maybe it should be less than 1%. That 4.5% withdrawal rate is the worst case scenario historically. It's based upon the investor who retired in October of 68. And within 5 years, he was hit with 2 huge bear markets. And then after that, he was hit for 10 years of high inflation. Inflation particularly damaging to investment portfolios because it forces you to increase your withdrawals, and it's a permanent increase. You can't get it back like you can with markets. So I don't think today's circumstances quite match the dire, nature of things back in the late 60s, early 70s, even though prospective returns for assets are pretty low. In fact, if you look at the picture across time, 4.5% is the worst case. The average investor was able to take out 7, if you just picked a random investor. And the maximum was actually 13%. One lucky investor was a couple of lucky investors able to do that. So the quoting of the 4% rule or 4.5% rule, I think, unnecessarily focus people on a worst case scenario. I think they can be probably more optimistic unless we get into a situation where PEs go to 100 or inflation, comes in a big way. That really concerns me, inflation more than anything else.
The thing that I loved about this most recent research is that you grouped withdrawal experiences by CAPE ratios and inflation rates. And you found in the research that even when prices have been high like they are now, if it's been in a low inflation environment, withdrawal rates have actually not been so terrifyingly low. And that to me was really, it was eye-opening that looking at both of those components, prices and inflation, can yield materially different results. So I just found that to be really insightful research.
Yeah, that kind of blew my mind too. That was a discovery I made this summer. It only took me 27 years to find it out. And it's funny because that's really the front end of the withdrawal process, how to choose a withdrawal rate. And up to that point, I didn't know how you could specify a withdrawal rate or take advantage of the very high withdrawal rates that occurred in the past. But for the first time, once we throw inflation into the picture, as well as stock market valuation, which Michael Kitces had developed, then you have a very, very close correlation between those two factors and what you can withdraw from your retirement portfolio. So it opens up whole new doors. Like back in 2009, March, the market bottom, using those tables I developed, 6.5%, 7% was doable. And if you look at that investor 10 or 11 years later, he's doing great. His portfolio is up substantially, despite the fact he's taken out much more than a 4.5% rate. So hopefully there'll be opportunities for that in the future. We can go higher.
So interesting. Do you think it's appropriate for someone who happens to be able to retire younger, so they have a retirement horizon of more than 30 years? Do you think it's appropriate for that kind of person to use the 4% rule in their planning?
The withdrawal rate is sensitive to the time horizon. So 30 years, you get 4.5%. If you go to 40 years, I think it goes down to 4.2. And, the longer you plan to live, the longer you plan to be, depending on your portfolio, the lower it goes. Although 4% appears to be, for a tax-deferred portfolio, even if you live a couple hundred years and the markets operate like this, I call that the Methuselah client, you're going to be okay. You don't have to do much less than 4%. And, that's my number. My colleague, Ryan McLean, who owns a company that built software that studies this issue, he recently published a study with even higher withdrawal rates than I've been able to generate because he used a lot more asset classes. And he went from 4.2, which, to 5.0. So that's why I'm not a pessimist. I think if you have a well-diversified portfolio, 4.5% is pretty penurious, pretty cheap. I think 5.5% is doable, even in this environment.
You mentioned the rule being sensitive to the withdrawal period. If we hold that constant and just say, let's talk about a 30-year period, are there scenarios, like we've talked about prices and inflation, are there scenarios where you would say, you know what, under these circumstances, I don't think the 4% rule does, or the 4.5% rule does actually make sense anymore?
Yeah. I played around with scenarios. I wanted to see what would it take to break the 4% rule or 4.5% rule, whatever you have it. And I came out with one scenario that the retiree encountered double-digit inflation for the first 15 years of retirement, and average returns, and that broke the 4% rule. That knocked it down to about 3.8. That's something we've never experienced. Doesn't mean we won't. That's why I say that the 4% rule is not a rule of nature. It's just a rule of thumb, experiential rule. So it could change, and it's changed in the past. In the 50s, it was not 4.5%, it was 5%. And it came down because of that big inflationary burst in the 70s.
Right. Along similar lines, other researchers have since you published your research, they've looked at the recreating the same analysis but in different countries. So I've seen it for up to 23 countries using the Dimson-Marsh-Staunton data going back to 1900. And the safe max, as you called it in your research originally, of 4% only holds in, I think, Canada and New Zealand and the United States. But every other country in the 23 country data set, the 4% rule does not work. And in some cases, it's really low, like 0.2% and stuff in Italy and Japan. Do you think people should take that survivorship bias into account when they're evaluating safe withdrawal rates?
Well, I guess it's country sensitive. I mean, my research has had a very narrow focus. It's basically been focused on U.S. investors, U.S. investments, U.S. bonds, U.S. stocks. So I'm probably not very well qualified to comment about what's happening, outside our borders. But yeah, sure, I could see it could be different if they have different return profiles, different inflation profiles than we did historically.
Right.
Can you talk about the impact of management fees on these numbers?
My research assumes that you are using funds with extremely low cost. So essentially, they match their index. And obviously, if you're investing in funds that are actively managed or have high fees, you're going to have to reduce your withdrawal rate accordingly. I think it's very important in the context of my research to use very efficient investments that reproduce indices reliably and don't saddle you with a lot of unnecessary costs.
So you are also a practitioner, and I'm really curious how you actually help people determine how much they should be spending in their retirement, like a real practical question.
Yeah, that's a tricky process. I used to start out by saying, what do you want to spend? And, what kind of lifestyle you want to have? And we sat down and we run numbers, and then I tell them or advise them whether or not I think, based on the extent of their financial resources, whether they can live that kind of a lifestyle. If not, let's see, maybe we need to make some changes. I don't think it makes sense to take more risk in your investments to get a higher withdrawal rate. That's dangerous because there's no guarantees that'll happen. People can't control what happens in the markets, but they can control what they spend and how they behave and how they live. So I generally focused on those aspects rather than trying to promise them something in the investment realm that was not deliverable.
So how often would you follow up on that process? And if they're ahead or behind, would you encourage them to spend more, to hold back? Like, how would that relationship work on an ongoing basis?
Yeah, I used to, in my annual meeting, I used to develop a new forecast, and compare it to the original estimate of where their portfolio should be. And if I felt they were diverging, one way or the other, I'd say we either cut back or, we could free up a little bit. I've gotten a little bit more sophisticated on that in the last year or two because I'm starting to use what I call templates, where I actually take a historical year, which starts with the same CPI and CAPE that my client, happens to have, and use that as a model, a template that they can measure their real portfolio's growth against. Most retirees, their portfolio will grow, even though they're taking money out. It'll grow substantially during retirement. So I compare it every year, and I've been developing an understanding of the triggers that are necessary to recognize that something is seriously wrong and that you need to do something. In some cases, even though it looks like there's large deviations, there may not be a reason to act because the markets may be at a bottom and they're about to come roaring back and restore, your wealth. Other times, if inflation is picking up and starting to become a serious problem, I've learned you need to really start getting cautious early with inflation. Don't wait 5 years for 8% inflation to chew away at your assets.
I want to dig into that a little bit more. If someone is following the 4% rule or the 4.5% rule, and they've got their head down and they're trying to focus on using this as their long-term spending rule, what would the triggers be, if any, for them to change it? To say, I'm not going to follow the rule this year. I'm not going to make the inflation adjustment, or I'm going to reduce the equivalent percentage withdrawal rate. Is it inflation or volatility? Like, what would the triggers be to make a change?
Well, my method is very graphical. So I would have a chart that shows how their portfolio has grown from day one of retirement, and then I want to have overlaying with that the chart of the template showing how the template portfolio grew. And if they are falling behind in their balances behind what the template, we have to start asking questions. Is this a serious problem that we need to do something about? And usually if it's market related, it can wait because, markets take and they give. And once inflation just takes, inflation doesn't give back. So if it's an inflation-related issue, I'm probably going to be much more aggressive and advise my client to make changes, to hedge against a possible risk, portfolio risk down the road.
That's a really, really interesting concept. We do something somewhat similar with Monte Carlo, where we'll do a retirement projection and then we'll compare where somebody actually is to where we expected them to be based on the Monte Carlo. And you're talking about doing something similar, but mapping their starting retirement scenario to an actual historical scenario and seeing how they track to that. That's a really cool idea.
Well, yeah, imagine if you're starting at a CAPE of 8 and an inflation rate of 0, the potential for your portfolio over the next 10 to 20 years is enormous, so 8, 9, 10% withdrawal rate may not be crazy based on that.
That's really interesting.
So kind of find the scenario in the past that matches where you are today and do a comparison.
Well, there really isn't one. And that's the issue. We won't know, unfortunately, for another 25 or 30 years what really transpired from all this. But once again, I'm more concerned about inflation. I think to a certain extent, even though the CAPE is high, it may be as high there are some reasons, related to interest rates and so forth and discount rates, and it may not be as extreme as it appears at first look. So still doesn't mean that the prospects for returns are pretty muted, across most asset classes. It's not a very pretty picture.
We had Professor Moja Milewski join us on the podcast recently, and he argued that having a fixed, real withdrawal rate doesn't make sense, and he was quite emphatic about it, and that spending from a portfolio of risky assets should actually be dynamic. What are your thoughts around dynamic spending rules?
I had developed some and looked at them, and I mean, to a certain extent, I think most retirees probably do that on their own anyway. If the market would have dropped 20, 30% over the next year, a lot of retirees are going to be pulling their ears in. They're going to be cutting expenses. They just don't feel good about things. And that may be a good thing. But I think going into retirement, retirees would feel most comfortable if they establish a lifestyle that they can maintain without very large fluctuations from year to year. Some people, it may be very difficult. They may have such high fixed expenses. They can't take a 30% cut, on expenses, or just be extremely painful. They don't want to do that. So I tried to plan using an approach where they could establish a lifestyle first day of retirement and maintain that through thick and thin throughout retirement. And that seemed to appeal to my clients. They liked that idea, opposed to alternatives.
I have another practical question for you, Bill. A lot of people that we work with have a hard time knowing exactly what they're spending per month. Do you have any tricks to help people get their arms around that number? Like, is it a spreadsheet? Is it linking electronically to your bank account? Any advice?
Well, yeah, that's a real fundamental. I think people need to keep track of their expenses. A program like Quicken or Money or something else, which are very easy to use. You just enter your transactions in there, keep a track, develop a budget, and track that against plan. I think that's essential for good financial practices, I encourage all my clients to do it. Not all of them did it, but, it benefited those who listened.
For sure.
Yeah, that's a tough one to get adherence to sometimes with clients, because it's work. It's real work to maintain a budget. Do you have thoughts, Bill, on we're talking about retirement income here? Do you have thoughts on using annuities, fixed annuities, as part of a retirement income plan?
Yeah, I think every financial instrument has its place somewhere, in the spectrum. And there are clients who may be concerned about the depletion of their portfolio coming up, into their late 70s, where they can get pretty good rates on annuities. It might make sense to do that. Take $500,000, $250,000, convert it to annuity, and take the worry out of the market worry out of their life. There could be a lot of good reasons to do that. That can make sense. Annuity rates are very low now, but I think they're pretty decent if you get up into your 70s, and I think they're worth looking at. Certain circumstances.
What are your thoughts, or what is your experience with tapering a retiree's income needs over time? For example, we have a number of clients, let's say I want more in the first, say, 15 or 20 years when they might be more active, and then taper later on in life, knowing there may be a risk of perhaps higher healthcare costs later on. Do you have a lot of experience with that with retirees?
Yeah. When I did my book about 15 years ago, I took a look at that specific situation, because there are clients who want to travel and do other things early, first 5, 6, 7 years of retirement, then taper down. And yes, you can do it. The thing is, since you're putting a front load on your portfolio, and early things that happen earlier in retirement are the most important. You spend more during retirement, and then you decide to decline. The drop off is really sharp. You might have to go from 4.8 to 3.5 or something like that. So you have to be prepared for the fact that when you spend early, you're going to have a lot less ability to spend later. And maybe that's acceptable to some folks, but your concern there about healthcare, and there are some other costs in the picture that shouldn't be ignored. So,
in reading through your research, Bill, one of the things that came up, and it comes up in other people's safe withdrawal rate research as well, is that bonds tend to actually make things look worse. People tend to think bonds is safe and is a good retirement asset, but when you look at just the safe withdrawal rates, you can do better by owning stocks. So how do you think investors should be thinking about the role of bonds in their retirement portfolio?
Well, the last 30 years, I think bonds really added value to the portfolio. In fact, I think that if you had invested in 30-year bonds instead of stocks, you would have done better from a total return point of view. But that's the past. Now we're a period of time where interest rates are low, and capital appreciation bonds is probably going to be negligible from here. Interest rates can't go much lower, so that bonds no longer offer diversification benefit or income benefits that they used to. So I think thought might be given to reducing bond allocations, at least temporarily, till interest rates rise, to more comfortable levels, because they ain't doing much for you, right? And in fact, it'll cause you to lose money, which is not happy.
An extension of that idea of stocks from a safe withdrawal rate perspective being better than bonds came up in a 2016 paper that you did, or article that you did, where you actually showed that being 100% in small cap stocks gave better results over most time periods. Now, this is something within our podcast community that comes up a lot. We know what the evidence says about small cap value stocks. We know they have higher expected returns. So a lot of the people in our community come to the logical conclusion that, well, what we should just all be in 100% small cap or small cap value stocks. Why do you think, like you've done this research showing that small cap stocks give better safe withdrawal rates? Why would retirees not go all in on small cap stocks?
Well, for a couple of reasons. They're a very volatile asset class. I mean, they've had years when they've been down 65, 70%, and years when they've been up 150. So there's an enormous range. And not everybody can tolerate that kind of volatility in a portfolio. You know, the portfolio going up 50% or rising, even if you know in the back of your mind it's going to work out, you know, over the long term. That's true for clients. I think it's true for advisors too. You know, I think it'd be very uncomfortable for advisors to sit there and explain to your clients where your portfolio is down 50%, but don't worry about it. You know, that's really a hard story to sell. Also, if a lot of small caps in general are a very small capitalization part of the market, and if a lot of people try to adopt that strategy, it'll be probably invalidated, just like the January effect. Everybody got in and you know, it's no longer there because you're going to lose that high return effect. There's too many people are chasing those returns.
That was another one of your more recent pieces of research that I read, and it was just fascinating. Well,
yeah, I find out that in this research, that I've just got to follow where the evidence leads and not try to go ahead with preconceived notions about what I'm going to find. I had no idea what I'd find out when I started that crazy experiment with small cap stocks. You know, I call it like the exports of investing. It's going 100%, but there were a lot of years when that worked. 100% allocation of small cap stocks did work, and it generated an average withdrawal for the average investor. 13% was the average, and one lucky investor got 25%. It's hard to imagine withdrawing 25% of your portfolio and still having it last 30 years. But that's the nature of the beast.
Well, listen, we did a podcast episode a few months back where we looked at safe withdrawal rates for a bunch of different equity asset classes, and we found something similar. We found that the best safe withdrawal rate came from U.S. small cap value stocks in the historical data. So it wasn't necessarily a surprise to us, but it is fascinating to think about. And it's hard to think about because we just talked about the behavioral reasons why you wouldn't do it. But like you said, if you step back from that and just think about it logically, it's not easy to say that you shouldn't be all in small cap value stocks. For the reasons that you described, I agree that people probably shouldn't do it. And I wouldn't personally do it, but there's a bit of cognitive dissonance there.
Well, for a retiree who's in real trouble with his retirement plan, and if you encounter the right circumstances, maybe it's toward the end of a bear market and things are starting to look up and small caps are prospects, maybe that would be the panacea for that particular individual. Just to build his, give him that extra kick to make him last 30 years or whatever he needs. So it's just a possibility, another arrow in the quiver.
Yeah, that would have worked the last 6 months or so. That would have been that would look pretty good.
So your story, Bill, of how you ended up becoming a financial advisor and then the creator of some science around the safe withdrawal rate, I find to be a fascinating one. You had quite a career. You have to tell us a story of how this all happened.
How I became an advisor?
Yeah, like your business story leading to financial advisor, leading down this path of research to safe withdrawal rates.
Well, I was a young kid. I was really interested in space exploration. So I went to an engineering school and got a degree in aerospace engineering. But when I graduated in 1969, that was just a few months before the moon landing, I could see that there was nothing on the horizon in that field, that it was going to be a desert because the government had spent an enormous amount of money over and accomplished their objectives, and now they're going to be pulling back. and there would be no funding for a lot of the projects. I like particularly planetary exploration. What they're doing now, sending probes to Mercury and Pluto and Mars, it just makes my mouth water. I just think, what a wonderful time to be involved in that field. So I got out of school, didn't want to really get into that field, spent about a year thinking and wasting time. And eventually my dad convinced me to go into the family business, which was a soft drink bottling firm in Long Island, which had, pretty big area. We had served 7 million customers in New York metro area, and we had 7-Up as our prime brand. And I swore I would never go into that business because I done it as a kid and I thought it was boring. And well, it turned out it was a great experience for me. I learned a lot about business, learned a lot about computers because I helped them computerize the business. And I ran it the last 5 years. And at the very end, was the person who told the family, it's time to fold the hand, folks. It's time to sell. Competitors are getting too big for us to handle. So let's get what we can for the business. And we sold it, which timing turned out to be great because a couple of years after that, our primary brand, 7-Up collapsed from competition from Coke and Pepsi. And when I moved out to San Diego with my family from New York, I spent about 6 months just thinking about, various options I want to do, and thought of financial planning. Since I had some wealth accumulated, I would need to do financial planning for myself. And I said, why don't I learn enough about that where I can turn that into a career? Because I see it was an up and coming profession. Mm-hmm. Found NAPFA, joined them, became fee only, and had a great 25 years. It was early in my practice, so I guess the early 90s, I started having clients about my age, about 20 years from retirement, 25 years, come to me, and they're starting to think, well, I'm going to be retiring before too long. I got to start saving money, and I got to know what kind of lifestyle I can retire in. How much can I spend, and how can I set up my investments, to do this? And I find nothing. I went back, I passed the CFP in 1990, and I went back, I said all the textbooks, couldn't find anything about that, and research. And, back then you didn't have the internet. It was not as easy to research things as it is today. So I got frustrated and I said, okay, I can't find anything about this. Nobody seems to know anything. I'm going to go out and do the research myself. So I got a book of return data, on markets, CPI data, sat down in front of my computer, got out my trusty spreadsheet and started cranking numbers. And that was a lot of fun because it was like going out on a voyage of discovery, like Columbus, going out and looking for a new land, not knowing what you're going to find. And there's something new and interesting at every turn in the research. And it continues to this day, still finding interesting stuff after all these years.
Bill, you were early to the fee only practice. That's become much more common now in the United States and increasingly so in Canada as well. Our firm in Canada is the Canadian equivalent of an RIA. What do you think about fee models? I mean, the fee-based model, which you did and we do, has come under some scrutiny more recently, where some people are saying that maybe that's not even the best fee model. What are your thoughts on fee models for financial advice? I'm not an active practitioner anymore, so that's not an issue that really occupies me to a great degree. But I think you need to have fees of some form to be professional, whether they're based on asset values, whether they're based on hourly, whether they're based on some other formula. I think to be a true profession, financial planning, has to be fee-based rather than commission-based. That's just my opinion. Yeah, well, I absolutely agree with that. One other question on your financial advice business or your experience in practice. What do you feel, looking back on that career, what do you feel is the biggest value that people who do what we do provide to their clients?
I got a feeling that every day I can make a difference in the life of my client in some way. They're very frustrated trying to deal. Financial matters are very complex, as you well know. There's so many aspects to the financial life, and people get very frustrated trying to learn about this, handling on their own. It was just a sense of relief my clients derived from dealing with me, somebody who had, studied the area and worked in it full time and could advise them in a very personal way about what they should do about their finances. For me, it was just making a difference every day in clients' lives in a very unique and personal way that was very satisfying.
That's a great answer.
Looking back, how do you feel about the way that the industry has adopted your 4% rule?
Well, I guess people still invite me to talk and write papers, so I guess there's still be some level of acceptance. It's pretty neat when you're 7 years retired and people, still think you're alive and not the alternative. I think most advisors are pretty sophisticated. I don't think most advisors just use a 4% rule and apply it to all clients. Okay, they know the score, and they do a lot of research and software work, and I think they're doing the proper thing in applying that research to their clients. What I'm trying to do now is giving more tools, more ways to help their clients by continuing to research and finding methods that can be used to generate withdrawal rates and track portfolios and determine when things become a problem and cures for problems. And that's the way I think can help. That's very rewarding too. But I think in general, the profession does a great job helping people with their retirement.
Yeah, the professionalization of the financial advice business has been amazing, even with the PhD programs in financial planning that have proliferated over the last decade or so.
Yeah.
Bill, you're still doing research. We talked about some of the research that you published in December. From what you're working on right now, what are you most excited about?
Well, that last piece of research I did, and I published in October in a magazine where I set up those tables within the inflation regimes. Okay. Yep. That was the last piece necessary to specify a complete program for specifying and managing withdrawals. And what I'm in the process now is I've written a paper for the Journal of Financial Planning laying that out, but it's a relatively short paper. I probably have to wait till my book comes out. I'm going to revise my book, greatly expanded because it's very chart intensive, and lay out the complete method that I recommend to be used for this. So from the get-go, from A to Z, soup to nuts, helping clients with their withdrawals. It's nice for the first time after all those years, almost after 3 decades, to actually have a complete rational method based upon some sort of, scientific or historical precedent that we could use instead of just saying, well, what withdrawal rate would you like to take? Take 6%, maybe you have a 60% chance of success, and 8%, maybe you have 20%. How does a client choose, between those percentages? How do they assess that? It's very difficult. But now I feel we can give them and say, hey, look, in this environment, this is what's worked. So we recommend you do that. It's a whole different approach.
Yeah, that most recent research that you've done is one of those things where it's so obvious once you think of it, once you see it, once you see the empirical results and the framework to think about it. But until reading it, I hadn't thought about it. But then you see it, and now it's so obvious. It's like, how has this not always been the way that we've looked at it?
Well, I had that aha moment when I saw that you could break inflation into 6 regimes and organize things in that structure. But after I did that, I said, I'm going to write a paper about this, but this seems so obvious to me. Well, anybody, they've probably all done it already. They figured it out already. I said, I'm looking at it. This seems so simple. But some things are like that, Just
yeah, it's very cool.
Incredible. Our last question for you, Bill, which we're always curious to hear our guest answers. How do you define success in your life?
That's a wonderful question for everyone, I guess. Before I go to bed each night, I've done this for a number of years, I ask myself 3 questions. And the first question is, today, did I learn anything new, or did I create something? That's one question. The second question is, did I do anything to help anybody, particularly people I love, but even if it's for a stranger? maybe helping an old lady across the street, or helping a child understand a math problem. And the last point is, have I given proper attention, to the mystery and wonder of the world and the universe and being alive and being able to experience all this? If I can answer yes to all those three questions during the day, I felt I've had a successful day. And if I look back over a period of years and think about all those days, if I felt the preponderance of those days were success, that I checked the box in 3 spaces those days, I felt my life was a success. By that standard, my first 40 years of my life were a total disaster. Not successful at all. The last 30 years, finding financial planning, helping clients helped a lot. But I guess maturing and learning things about life and what's important, what's not, So I just find that 3-question process helps me keep in mind what's really important to me in life and try to focus on achieving things in those areas. I think it adds up over time.
What a terrific answer. Thank you. It's been a great pleasure to meet you, Bill, and welcome you to our podcast. Thank you so much.
Well, thank you. I really enjoyed it. Best of luck to you, gentlemen.
It's great, Bill. That answer to the success question is probably the most analytically rigorous answer that we've gotten. Ask 3 questions every day and aggregate the data over time.
That's right. I love it. The 4% rule to that.
Oh, I love it. Thanks again, Bill. This was great.